recording. Okay, so today we'll be discussing, we discussed about P ratio yesterday. Today we'll be discussing price to book value, price to sales, and EV/EBITDA. After this, we'll only have asset-based models left to discuss, which we'll discuss in Saturday's class, and we'll finish off this particular chapter. Now we have to be very thorough with this chapter because equity valuation is a very big subject when we come to level 2, right? The emphasis given to equity valuation is a lot in level 2. Next, so now let's start our discussion with price to book. Okay, how do you calculate your price to book value? Price to book value is calculated by dividing the price of a stock by its book value per share. How do you calculate the book value per share, guys? How do you calculate the book value per share? Okay, now there are two ways in which you can calculate the book value of a share. I'll give you a small example. So this is your balance sheet, this is your asset side, this is your liability side, right? So in your balance sheet you have, say, current assets worth 400, fixed assets worth 700, and investments worth 400. Now you have your shareholder equity. Now shareholder equity consists of share capital and retained earnings, right? So it will consist of share capital and retained earnings. So say your share capital is 300, retained earnings is 700, total shareholder equity is 1000. And say you have debt in your books worth 200, and you have say current liabilities worth 300, right? So total of liability side 1500, total of asset side is also 1500. Okay. Now total number of common equity shares outstanding for this particular company is, number of shares outstanding is, say, 100, and net income of the company is 200. Guys, I'll dig deeper into this subject. Maybe I'll tell you more than what's written in the book, but that will help you build intuitive logic. Okay, now your book value is how much? Now understand, there are two ways in which we can calculate the book value. The first way is assets minus liabilities, right? So what are the total assets of this company? 1500. And what are the liabilities? Debt and current liability, right? Your shareholder equity is not a liability.
500.
So your book value is 1000. Now how will you calculate the book value per share? You will divide book value by the number of shares outstanding, number of common equity shares outstanding. So there were how many common equity shares outstanding? How much did I write, guys?
100. 100.
Yes, so your book value per share is 1000, which is your book value divided by 100. So your book value per share is 10, right? So this is how the calculation works. Like, this is the first way. This is the first way. Next way is, please understand, your book value is your share capital plus retained earnings, right? And share capital plus retained earnings is nothing but shareholder equity, right? Share capital plus retained earnings is nothing but shareholder equity. So please add the share capital plus retained earnings. Have you noted the balance sheet? So share capital plus retained earnings is 1000, or your shareholder equity is 1000. So your book value is 1000. Okay, so we get the same result in the first and the second method, right? Our book value is 1000 rupees in both cases, right? So whether you calculate book value as asset minus liabilities, or whether you calculate book value as shareholder equity, it will give you the same result. And book value per share is naturally shareholders equity by number of shares, number of common shares outstanding, right? So your shareholder equity is 1000 and number of shares outstanding is 100. So your book value per share is how much? 10. Now if the price of your stock is 30, if the price of the stock is 30, then what is the price to book value, guys? If the price
3.
of the stock is 30, what is the price to book value per share?
3.
3, right? 30 by 10, which is 3. How to interpret this number? How to interpret price to book value? Okay, so please note down, price to book value of 3 means that investors are willing to pay $3 for every dollar of book value. Investors are willing to pay $3 for each dollar of book value. Investors are willing to pay $3 for each dollar of book value. That investors are willing to pay $3 for each dollar of book value. Just a second, guys. Okay, guys, now look at this balance sheet and tell me how will we calculate ROE. You have your net income, right? And you have your shareholder equity, right? So your ROE is basically your net income by shareholder equity. Please write this down. ROE is equal to net income by shareholder equity. So my ROE is equal to, please calculate how much is your ROE. ROE is how much? Your net income by
0.2.
hmm, or shareholder equity. Can I write? Can I say that shareholder equity is nothing
Yeah.
but book value? Guys, can I
Okay.
write this? We
Yes,
just
sir.
saw that shareholder equity was book value. So your ROE is nothing but net income by book value, right? Your ROE is nothing but net income by book value. So your net income was 200, your shareholder equity or your book value was 1000 into 100. So your ROE is 20%. I've already told you the interpretation of this number. What is the interpretation of this number? Please tell me really fast. Bolo.
That for every month, 0.2 cents for every dollar invested of the shareholders' equity.
Yes, the company is generating 20 cents for company is generating 20 cents per dollar of book value per dollar of shareholder equity. Please write this down also. The interpretation of this number is company is generating 20 cents per dollar of book value per dollar of shareholder equity. So guys, this number should be a higher number is better. Guys, a higher ROE is better. because that basically means that the company is generating more profits per dollar of book value, right?
Yeah.
So the higher the ROE, the better the financial health of the company. Higher the ROE, better the financial health of the company. Because higher ROE would basically mean that company is generating more profits per dollar of book value per dollar of shareholder equity. Right? Guys, are we good up till now? Any doubts? Now you will understand why I am linking book value to ROE. You will understand this now. Uh, Guys, we said that what was my price to book value? What was the interpretation? Price to book value of 3 means that investors are willing to pay $3 for each dollar of book value. Guys, when will investors be willing to pay more per dollar of book value? Guys, when will investors be willing to pay more per dollar of book value?
If the company is booming, expanding.
If investors would be willing to pay more per dollar of book value if they feel that management can generate higher profits per dollar of book value. Guys, can you get this idea? Can we all of you get this idea, please? Investors would be willing to pay more per dollar of book value if they feel that the management can generate higher profits per dollar of book value. Guys, are we good with this idea? Everyone say yes or no first.
Yes, sir.
Yes, sir.
So please write this down first. Everyone write this down. Investors would be willing to pay more per dollar of book value if they feel that the management can generate higher profits per dollar of book value. Higher profits per dollar of book value. Right? So if the management, if the investors, if the market participants believe that the management can generate higher profits per dollar of book value, then investors would be willing to pay more per dollar of book value. Now, guys, please tell me which ratio measures the profits that a company generates per dollar of book value. Which ratio, guys?
ROE.
ROE, right? So, guys, can I say that investors would be willing to pay more per dollar of book value if they expect that the company is going to enjoy higher ROE? Can I say this, guys? Guys, can
Yes,
I
sir.
say this? All of us are all of us are we clear on this?
Sir, please repeat once.
Okay. What did I say? Investors will be willing to pay more per dollar of book value if they feel that the management can generate higher profits per dollar of book value. Right? Are we good till here? ठीक है?
Yes, sir.
Okay, now which ratio measures profits that a company generates per dollar of book value? Ankit,
ROE.
ROE. ROE measures how much profits the company generates per dollar of book value. So basically, investors would be willing to pay more per dollar of book value if they expect that the company would have a higher ROE. Are we good?
ROE. Yes, sir.
Right? Are we good? Everyone, is this crystal clear?
Yes, sir.
So please understand
Yes, sir.
stocks with high PB ratios have higher ROE, right? If the stock has higher PB ratio, that basically means that investors are willing to pay more per dollar of book value. And why are they willing to pay more per dollar of book value? Because that particular company has a higher ROE, right? And investors would be willing to pay less for which stocks? But investors would be willing to pay less per dollar of big book value for which stocks, guys? Guys, investors will be willing
The
to
stocks
pay
with lower
less.
ROE.
Yes, investors would be willing to pay less per dollar of book value for those stocks which have a lower ROE, right? So stocks with low price to book ratio have lower ROEs. Guys, is this concept crystal clear to all of us? Do we have any doubts here? Do we have any doubts? Please tell yes or no, everyone. Bolo chalo.
No, sir.
Good, sir.
All good, everyone?
Good, good, sir.
Okay. Okay. Now, just like the P ratio, we can use the PB ratio to identify undervalued or overvalued stocks. Right? So, when you compare stocks within the same industry and with similar ROE, the stock that trades at a lower price to book is undervalued, and the stock that trades at a higher price to book would be overvalued. Please note this down. When you compare stocks within the same industry and similar ROE, the stock that trades at a lower price to book is undervalued, and the stock that trades at a higher ROE is the stocks that trade at a higher price to book is overvalued. Right? I'm repeating this. When you compare stocks within the same industry and similar ROE, the stock that trades at a lower price to book is undervalued, and the stock that trades at a higher price to book is overvalued. Guys, please repeat what did I say? Please repeat. Bolo ek jan.
A stock within the same industry and similar ROE. The stock which trades at lower ROE is undervalued, trades at higher ROE is overvalued.
Stock that trades at a stock that trades at a lower price to book is undervalued, and the stock that trades at a higher price to book is overvalued. ठीक है ना? अंकित, ROE नहीं होगा. That stock that trades at a lower price to book is
Lower PBB ratio.
trades at a lower price to book ratio is undervalued, and the stock that trades at a higher price to book value is overvalued. ठीक है ना? So guys, now write this interpretation. क्या लिखा है? Supratik, please repeat. What did I just ask? What did I ask? Just asked you to write down. बोलो तो एक बार.
Comparing the same industry having the similar ROE, the stocks having low PV ratio is undervalued, and the stocks having high PV ratio is overvalued.
Yes. So guys, a low PB ratio can mean that the stock is either undervalued or the market believes that the assets of the company are overstated. The market believes that the assets of the company are overstated. Please note down. Assets of the company are overstated, and the value of the assets are expected to fall, and that is why investors are willing to pay less per dollar of book value. Right? So a low PB ratio can mean that the stock is undervalued, or the investors in the market believe that the assets are overstated. The prices of the assets of the company are likely to fall, and that is why they are willing to pay less per dollar of book value. Now, how will you identify a undervalued stock using price to book value ratio? Guys, the classical case is, if you find a stock with a low price to book but a higher ROE, then this stock, you can safely assume that this stock is a undervalued stock. Guys, this is the market actual thing that happens in the market. I'll just prove it to you. Right? Guys, now look at okay. And a low PB ratio could be, because the ROE of the company is low. Guys, the stock can trade at a lower price to book value if the ROE is low. Right? If the ROE is low and the stock is trading at a low price to book value, then the stock is not undervalued. Guys, please understand, then the stock is not undervalued, right? So if you see a low PV ratio, you can't come to a conclusion that the stock is undervalued. You have to compare it with the ROE. If ROE is high and price to book value is low, then you can assume that the stock is undervalued. But ROE is low and price to book is low, then guys, then that stock is not undervalued. Then that stock is not undervalued. Now I'll give you an example. Guys, look at the, go to Google, um, calculate, see the book value of PNB and the current market price of PNB and the ROE of PNB, Punjab National Bank. Okay, no, I have this data with me, guys. You don't have to go look. Yeah, I have this data with me. Okay, guys, now look at this chart here. In the first row, we have the financials and we have the fundamentals of State Bank. Second row, Bank of Baroda. Third row, Punjab National Bank. Guys, look at the ROE of Punjab National Bank. How much is its ROE?
4%.
And what is its price to book value? 0.57.
57.
Guys, and you will see here that as the ROE is increasing, the price to book value is also increasing. ROE of Bank of Baroda is 9, so it has a higher price to book than Punjab National Bank. ROE of State Bank of India is 12.18, that is why it has a higher price to book than Bank of Baroda and Punjab National Bank, right? So, you know, we can clearly see that price to book value of a stock is a function of its ROE. Higher the ROE, higher the price to book value, and lower the ROE, lower the price to book value. Now, if someone looks at the price to book value of Punjab National Bank in isolation, he will see that, oh God, it's less than 1, right? What does, how will you interpret a price to book value of less than 1, guys?
The market value is less than the book value of the share.
Yes, the market value of equity is less than the book value of equity, right? And you will be so happy that, oh God, I've found such a stock where the market value is less than book value. How is it possible, right? Because book values are, book values are always lower than your market values. Market values are always higher, right? Market values are always higher than the book values. So you will be excited that, okay, I found such an undervalued stock, and you'll go and invest in PNB without looking at its ROE. Arey, its ROE is so low, that is why it has a low price to book value. So PNB is not overvalued or undervalued. Please tell me.
Undervalued, not
Yes,
undervalued. Yeah.
PNB is not undervalued because it's trading at it's because it has a very low ROE compared to its peers. State Bank and Bank of Baroda are, you know, uh, peers of PNB. All these stocks are PSU banking stocks, right? Public sector banking stocks. So higher the ROE, higher the price to book. Lower the ROE, lower the price to book, right? So if you find a stock that trades at a lower price to book, please look at its ROE to, to come to a conclusion whether the stock is undervalued or overvalued, right? But guys, how will you find an undervalued stock using ROE? Guys, how will you find an undervalued stock using ROE? Undervalued stock using price
The
to book
ROE
value?
will be
High
high.
ROE, low PBB.
Yes. ROE is high, price to book is low. That is a classical, case of undervalued stock. You can safely invest in that particular stock, guys. You can safely invest in that particular stock. That is how we do fundamental analysis in the real world. See, I'm not teaching you from the book, I'm teaching you from my experience in the market for so many years, right? That is why I can correlate these actual numbers, right? What we spoke we can correlate that with the actual figures. Now guys, look at private sector banks. HDFC, ICICI, Kotak, all these are private sector banks. You can see that HDFC Bank has the highest ROE, and that is why it has the highest price to book value. Guys, can you see this please?
Yes, sir.
It has the highest ROE, and that is why it has the highest price to book value. Right? Investors are willing to pay. Guys, please interpret 3.61. Please interpret the price to book value of HDFC Bank. Guys, what do you mean by this number
Investors
3.61?
are willing to pay 3.61 for every $1 book value of the
And why are
stock.
they willing to pay such a large amount? Because the ROE of this bank is high. Right? Because the ROE of the bank is high. Yes Bank's ROE is how much? 3
3
point.
point.
That is why investors are willing to pay only $1.24 for each dollar of book value, right? And you can see, guys, more or less, you can see that as ROEs are declining, right? ICICI Bank ROE is 14.8, so investors are willing to pay less per dollar of book value. They are willing to pay only 3.24, right? So you will see that as ROEs decline, price to book values also decline, right? So you should look at price to book value in conjunction with ROE, right? You cannot look at it in isolation. Guys, is this clear? Guys,
Yes.
is this clear? Right. So we'll come down. So guys,
सर
find.
बट इसमें तो कोई भी अंडरवैल्यूड स्टॉक नहीं है ना अभी.
अभी सब ओवर वैल्यूड है जो बाजार चल रहा है सब ओवर वैल्यूड है, ठीक है ना. अंडर वैल्यूड ओवर वैल्यूड इज परसेप्शन, ठीक है ना. सब परसेप्शन का गेम है. देख, आदमी का सेंटिमेंट से ज्यादा अंकित कुछ भी नहीं होता है, पता है. मूड खराब है ना, तो सब स्टॉक बेच देगा. अब ना, व्हाट इज रॉन्ग विद अदानी? अदानी हैज प्लेस्ड ऑल इट्स शेयर्स to as a collateral to secure the loans that he has taken, right? Now as the price of its stock is declining, the value of its collateral is also declining. So the bank will ask Adani to pledge more shares to secure the loans that he has taken. Now this will result in a cascading effect, guys. See, when the price is falling 25-30% like this, right, then all these, Adani has pledged a lot of his stocks to secure the massive debt that he has taken. Okay, na? So as the price of the stock would fall, the collateral will also fall. The collateral, the value of the collateral that he has pledged, because he has pledged his shares as collateral with the bank. Now, as the price of the stock is falling, bank will all ask more collateral. तो अदानी का लंबा गेम है ये, इसको कोई मजाक मत समझना.
और सर उसने वैसे भी प्राइसेस तो सारे रिग्ड ही है ना उसके, मतलब एफपीआई एफडीआई से आके तो
सब
प्राइस
पता
रिग
नहीं
हुआ
क्या
हुआ
है,
सारा.
हम लोग उसके सामने छोटी सी मछली हैं.
लो
दोनों
पीवी एंड हायर आरओई का एग्जांपल.
मिलेगा तो मैं शेयर पहले खरीद लूंगा श्रेया, ठीक है ना. ढूंढूंगा. कल मैंने वी वर डिस्कसिंग स्टॉक, एन अंडर वैल्यूड स्टॉक, कोल इंडिया, राइट. We saw that stock had no debt in its books, and it was showing 70% growth in profits. And ROE उसका कितना था? What was the ROE of Coal India? We were discussing yesterday. ROE was around 43.
43%.
Yes. And we had said that Coal India was a monopoly business. So we had seen those factors and concluded that the stock was relatively inexpensive given its growth potential. It was trading at a P of around 4.6 or 4.7, right? So we had identified one undervalued stock on the basis of P. On the basis of price to book value, मेरे को खोजना पड़ेगा, मेरे को मिल नहीं रहा है उसमें, ठीक है ना. तो पहले मिल जाएगा तो मैं खरीद लूंगा, फिर तुम लोग को भी बता दूंगा.
ओके सर.
मिलना ये सब मुश्किल होता है, राइट? बिकॉज मार्केट इज वेरी एफिशिएंट, राइट? मार्केट इज वेरी वेरी एफिशिएंट. ओके, सो
Sir,
हाँ,
if a book
बोलो. हेलो.
हेलो हेलो.
हाँ बोलो.
सर अगर कोई बुक वैल्यू मतलब शेयर है उसका लाइक 0.05 या 0.6 है एंड
हाँ
उसका ROE इज लाइक मोर देन 100,
हाँ.
is something is wrong or it's like कि means we have to see other factors also, right? कि सिर्फ इन दोनों के बेसिस पे तो हम डिसाइड
नहीं,
नहीं कर
I
सकते.
will come to one more thing ना. I will come to one more thing also that I will tell you, that price to book value is useful only for valuing capital intensive industries. It's not good for valuing industries where human capital or where intellectual property is involved. I'll come to that point. तब ये clear हो जाएगा. ठीक है ना? I'll come to that point. Okay. So guys, what will a high PB ratio mean?
That
Can mean
investors are willing to pay
first is
more.
that the
Generating more
stock is
returns.
overvalued, right? It could mean that the stock is overvalued. And a classical example of a classic overvalued stock would be high PB and low ROE, right? That would be a classical example of a classical example of an overvalued stocks. And right, high PB ratios, stocks with high ROEs would have higher price to book, right? Stocks with high ROEs would have higher price to books, right? Investors are willing to pay more per dollar of book value for such stocks because because the stock has a higher ROE, because the company has a higher ROE, it is generating more income per dollar of book value. So guys, the broad idea is that a low price to book value does not mean that the stock is undervalued, right? And a high price to book value does not mean that the stock is overvalued. We have to look at price to book value in conjunction with other profitability measures such as ROE. Please write this down. A low PB ratio does not mean that the stock is undervalued, and a high PB ratio does not mean that the stock is overvalued. We have to look at price to book in conjunction with other profitability measures such as ROE. Guys, have we noted this down? लिख लिया ये? Guys, are we good? Have we noted this
Please
down?
repeat, sir.
A low PB ratio does not mean that the stock is undervalued, and a high PB ratio does not mean stock is overvalued. We have to look at price to book in conjunction with other profitability measures such as ROE. Second, please note that there is no single good price to book value ratio, because just like P ratio, price to book value ratio is a comparison tool. It is a relative valuation tool and not a benchmark figure. There is no single good price to book value ratio because it's a relative valuation tool, a comparison tool, and not a benchmark figure. Guys, have we noted down these 2 points?
So second point repeat कर दो.
Yes.
Second point, Sankush, there is no single good price to book value ratio because it's a relative valuation tool / it's a comparison tool and not a benchmark figure. Third point, please note, price to book value is useful for companies that have large physical assets, large financial assets in its balance sheet. I'll write this point only. It's useful for valuing companies that have large physical assets. Physical assets basically tangible assets. Tangible assets are assets that you can touch, like your plant and machinery, property, right? Your land. It's useful for valuing companies that have large physical assets. That is, it's useful for valuing capital intensive industries. Can you give me some examples of capital intensive industries?
sugar mills,
Yes, so you have your, all these textile mills.
Automobile.
Your banks have a lot of financial assets, right? We also spoke of financial assets. It's useful for valuing companies that have large financial assets. And guys, price to book value is best for valuing banking companies, right? It's best for valuing banking companies because banks have financial assets on their balance sheets, and it's very easy to assess the value of these financial assets, right? So please note this down as well. Price to book value is more appropriate for valuing banking stocks, and it's useful for valuing capital intensive industries with a lot of plant and machinery, property, building, land, etc., etc. So
Yes, sir, but financial assets are not tangible assets.
yeah, financial assets are not tangible assets, but you know their values can be measured easily, right? Value of physical assets like plant and machinery, it will be difficult to value those assets, but it will be very easy to calculate the value of financial assets, right? So banking stocks usually measured through price to book value. Okay, now please note down, it's not useful for valuing a company that has intangible assets. What are intangible assets? Price to book value is not useful for valuing companies that have intangible assets. What are intangible assets, guys?
human resource, goodwill.
Patents,
Yes,
intellectual
intangible assets are basically
property,
assets that you can't see, you
goodwill.
can't see it and touch, right? So, if a company has a lot of intellectual property, if the company has brand name, right? Will brand name and intellectual property, are brand name and intellectual property reported on the balance sheet of a company, guys?
No.
No. So, uh, you know, since intellectual property and brand name, such things are not reported on the balance sheet, they are not accounted for while calculating your book value, right? So for companies which have a lot of intellectual property, for companies which have brand name, right, um, these intellectual property, these brand names are not reflected in the book value, right? And for such companies, um, using price to book value is not appropriate, right? For valuing such companies, price to book value is not appropriate, right? Like think of Microsoft, guys. It has a lot of intellectual property rather than physical property. Think of Infosys. It has a lot of intellectual property, right? Its value is based on its human capital, not its physical capital. Think of TCS, think of Cognizant. All these firms have a lot of intellectual capital. All these firms have a lot of human capital rather than physical capital. So, for such companies, um, for the valuation of such companies, price to book value is not appropriate, right? Because intellectual property brand name is not reported is not accounted while we calculate book value. Even if we calculate for Apple as well, we can't use price to book value for valuing Apple, because Apple also has a lot of intellectual property, right? All the iPhones that it manufactures are all outsourced, right? It's only using its intellectual property. iPhones are usually manufactured in China, right? So it's outsourcing most of its production. So it has a lot more intellectual property rather than physical property, and that is why price to book value won't be appropriate for valuing such companies. Right, guys? Are we good? Any doubts, guys? Is anyone
No,
having
sir.
any confusion?
Good say.
तो कल कौन ढूंढेगा मेरे लिए हाई पीबी लो आरओई?
शायद एग्जिस्ट ही नहीं करता है ऐसा कुछ।
नहीं नहीं, पक्का होगा, हमें मिल नहीं रहा। ठीक है ना, खोजने पे तो भगवान मिल जाता है। तो हमें मिलेगा, अभी दिख नहीं रहा, ठीक है ना. But don't use ROE, don't use price to book value when you analyze technology companies. Basically, when you analyze all these technology companies, all these IT firms, you should not look at price to book value. You
So
should
what do we look at for
technology
technology?
companies, should look at price to earnings, right? And there is
Okay.
some other ratio which is PEG ratio, price earning growth ratio. This is not a part of your syllabus. It will be a part of your syllabus in level 2. I'll tell you that then, right? For technology companies, you should look at price to earnings. Okay, guys, the next ratio is price to sales. How do we calculate this? Price by sales per share. Now, this ratio is hardly used in the markets, right? But it has just one advantage. Can you think of it, guys? What would be the advantage of this particular ratio?
It shows the real time when the sales are increasing.
No, so the thing is that many companies, they have negative earnings, right? Many companies have negative earnings. So if they have negative earnings, then P ratio would be quite meaningless, right? Guys, if EPS is negative, then your P can't be negative, na? P can't be negative. So for stocks which have negative earnings, P ratio is not useful, right? Then P ratio basically becomes meaningless. So for such companies which have negative earnings, we can use price to sales ratio, right? Please note this down. P ratio is not useful for valuing companies that have negative earnings. If earnings are negative, P ratio is meaningless. So we can use the price to sales ratio. We can use the price to sales ratio for valuing companies with negative earnings. Sales can't be negative, right? Sales shall always be positive. And there's not much to discuss with this particular ratio. This is hardly used. No one ever uses this ratio in the real world, guys. In the actual world, we hardly use this. Last and but not the least, EV by EBITDA. Okay. Guys, what does EV stand for?
Enterprise value. Asset value.
Enterprise value. Okay, how do we calculate enterprise value?
Value of equity plus value of debt.
Market value of equity plus market value of preferred equity. Please write this down. Market value of equity, common equity plus market value of preferred equity plus market value of debt. Minus cash reserves, minus cash and cash equivalents. Right. Now, what is the intuition behind enterprise value?
Minus cash equivalents.
Cash and cash equivalents, yes. So basically, enterprise value tells what an acquirer would pay if if it were to acquire a target at the current point of time, right? What an acquirer would have to pay. So there is some big company that wishes to acquire some small company. So what an acquirer would have to pay to acquire this small company at the current point of time. So guys, when you buy a company, you have to repay its existing shareholders, right? Guys, are we good? If you buy a company, you have to repay its existing shareholders. That would be an outflow for you, right? So this is an outflow for you. You have to repay the existing shareholders. What would you repay them? The market value of equity. Guys, if you acquired a company, you would also take over the debt of the company, right? Now, if you acquire a company, it will become your responsibility to repay the debt of that company, and this too would be an outflow for the company, right? The acquirer would need to repay the debt holders of the target company, right? So that too would be an outflow, right? And guys, once the acquirer acquires the target, the acquirer gets the cash reserves of the target. Once the acquirer acquires the target, he gets the cash reserves of the target. Now, what the acquirer can do is that he can use these cash reserves to repay the debt of the target, right? He can use the cash reserves to repay the debt of the target, right? So this cash and a cash equivalent would be an inflow for the acquirer, right? So this is what your enterprise value basically means. It tells what an acquirer would have to pay if he were to acquire the target at the current point of time, right? The acquirer would need to pay the equity shareholders of the target company. He would have to repay the debt holders of the target company. And once he acquires the target, he gets the cash reserves of the target. He can use those cash reserves to repay the debt of the target, right? So that is why we are deducting cash and cash equivalents, because it's an inflow, and this inflow can be used to repay the debt of the target, right? Guys, do we have the intuition of enterprise value? Guys, do we have an intuition of what enterprise value is? Any doubts, anyone? Guys, please let me know if you have any doubts.
Good, sir.
Okay, so
So please explain the cash and cash equivalence wala part there. How can it be a inflow for the acquirer?
Umang, you buy a company, then the cash of the company is yours. Just like the debt of that company is yours. Just like just like the debt of that company is your debt now. In the same way, the cash of the company is your cash now, right?
Okay.
So
Yes.
you can use that cash. You can use the cash of the target to repay the debt of the target, right? So that is
Okay.
why we are deducting cash and cash equivalents while calculating enterprise value. ठीक है ना?
Okay, sir.
So once you buy the target company, everything of the target is yours, right? Its assets is yours, its liabilities are yours. You can use the cash of that company, you can use the cash of the target company to repay the debt of that target company, right? So this is your enterprise value, which is basically telling you what an acquirer of a firm needs to pay to those who have a financial interest in the firm, right? So if you acquire the company, you will have to pay the equity shareholders of the company. That would be an outflow for you. You have to pay the debt holders of the company. That would be an outflow for you. And once you buy the target company, its cash is yours. You can use that cash to pay the debt holders of the target company. So that is an inflow, and that is why the cash and cash equivalent of the target is deducted while calculating enterprise value, right? Guys, are we good here? Any doubts, please ask yes or no, guys.
सर एंटरप्राइज वैल्यू का एग्जैक्टली यही है ना कि व्हाट एन एक्वायर like needs to pay to the stakeholders.
Yes, what the acquirer needs to pay to acquire the stakeholders of the target company, right? Exactly. What it needs to pay to the stakeholders of the target company to acquire the target company. Absolutely correct. Guys, should I move forward? Anyone's having any kind of doubt, please ask me now.
No, sir.
Okay. Now, what's the problem that you will encounter while calculating EV? Guys, what problem you might face while calculating EV? Guys, please note down. Uh, Guys, the problem with the calculation of EV is that market value of debt is not easily available. The problem while calculating EV is market value of debt is not easily available. Guys, market value of common equity is easily available, market value of preferred equity is easily available. But if your debt is not listed, if your debt is not listed, then the market value of debt is not easily available. Right? If the debt is not listed, you won't be able to find the market value of debt. Right? So the problem with the calculation of enterprise value is that the market value of debt is not easily available. So in such a case, the analyst should use the book value of debt. Right? Please note that if market value of debt is not available, if the market value of debt is not available, then the company should use book value of debt. Okay, guys, now we've discussed what EV is. What is EBITDA? What does EBITDA stand for?
Earning before interest, depreciation,
Tax and amortization.
tax, amortization.
Earning before.
Sorry, I missed out on when the market value for debt is not available.
Yes, so
What
when
should you use
market
instead?
value is debt is not available, an analyst should use the book value of debt instead. He should
Okay.
use the book value of debt. Now, EBITDA stands for earning before interest, depreciation, tax, and amortization. Earning before interest, depreciation, tax, and amortization. Right? Now, what does EBITDA signify? What does it reflect? Right? It basically reflects the profits generated by the company's core operations. Right? It reflects the profits generated by the core operations, and it is not including, or basically it's in you know it's basically excluding non-cash expenses like depreciation and amortization. Right? It's excluding non-cash expenses such as depreciation and amortization, and it's also excluding non-operating expenses such as interest and tax. Right? For a manufacturing concern, interest would be a non-operating expense. Right? For a manufacturing firm or for a non-financial firm, interest would be a non-operating expense. So basically, EBITDA excludes your non-cash expenses like depreciation and amortization. Right? We understand why depreciation and amortization is non-cash. Right? It's an expense that does not that does not involve an outflow of cash. Right? And interest and tax are non-operating expenses for non-financial firms. So it's basically excluding non-cash and non-operating expenses, and that is why it's reflecting the core profitability of the company, right? Or the profitability generated by core operations, right? So please write down, EBITDA basically refers to the profits generated by company's core operations. It excludes non-cash expenses like depreciation and amortization. It also excludes non-operating expenses like interest and taxes. And give a
सर
star.
ये तो ग्रॉस प्रॉफिट ही हो गया ना एक तरह से.
हम्म, नहीं, ग्रॉस
ग्रॉस
प्रॉफिट नहीं हुआ.
प्रॉफिट.
नहीं हुआ, ग्रॉस नहीं हुआ. इसमें कुछ ऑपरेटिंग एक्सपेंसेस कटते हैं, ठीक है ना. ग्रॉस प्रॉफिट में ऑपरेटिंग एक्सपेंस भी नहीं कटते. While calculating gross profit, your administrative expenses, selling and marketing expenses are not deducted from gross profit, but to the best of my knowledge, from EBITDA, these expenses are deducted.
Okay.
So your operating expenses are deducted from your EBITDA. Okay, so what was I saying? What have you noted down, guys? Please let me know.
EBITDA basically refers to the core operations profit of the organization.
Hmm. And it excludes what? It excludes
Non-cash expenses.
Non-cash
expenses such
expenses,
as depreciation
interest
and
and tax.
yes, non-cash expenses such as depreciation and amortization, and it also um, excludes tax and interest
Excludes
which are
operational.
non-operating. ठीक है ना?
Yes.
Now come to the ratio EV by EBITDA. Right? What does this ratio signify? Guys, again, the logic is very simple. How much an acquirer is willing to pay for every dollar of EBITDA. Your EV by EBITDA reflects how much an acquirer is willing to pay for every dollar of EBITDA. Okay. So, guys, when will an acquirer be willing to pay more per dollar of EBITDA? When will an acquirer be willing to pay more?
When the company is having earnings are more from
Yes,
their
an
core
acquirer
operations.
would be willing to pay more for EBITDA if the acquirer is optimistic about future EBITDA growth. Right? So please note down. Now everything is the same. What we've been discussing since yesterday. An acquirer would be willing to pay more for EBITDA if he's optimistic about future EBITDA growth. Right? So EV EBITDA would be higher for stocks with higher expected EBITDA growth. And an acquirer will be willing to pay less if he is not so sure of future growth in EBITDA. Now, EV by EBITDA can be used to identify stocks that are undervalued or overvalued, right? So, we compare stocks within the same industry and same EBITDA growth. The stocks that trade at a lower EV by EBITDA is undervalued, and the one that trades at a higher EV by EBITDA is overvalued, right? So, the same logic. Guys, the logic is the same. You compare stocks within the same industry and same EBITDA growth. The stock that trades at a lower EV by EBITDA is undervalued, and the one that trades at a higher EV by EBITDA is overvalued. And just like PE, price to book, EV by EBITDA is also a comparison tool, and there is no single good EV by EBITDA. It varies from industry to industry. Your EV by EBITDA would vary from industry to industry, right? Okay. Now, guys, what there is one question that they might ask you in the examination. What is the benefit of using EBITDA as a measure of profitability? Guys, please note this down. Make a heading. Please write the benefit of using EBITDA as a measure of profitability is that EBITDA is usually positive even when net income is not. Please write down the benefit of using EBITDA as a measure of profitability is that EBITDA is usually positive even when net income is not. When net income is negative, valuations based on earnings are meaningless. When net income is negative, valuation based on earnings are meaningless. Guys, have you noted this down? All good? Guys, all good, please? Yes or no?
Yes, sir.
Yes, sir.
मजा आया आज का क्लास में? समझ में आया चीज, प्रैक्टिकल चीज? ये सब बहुत प्रैक्टिकल चीज बताया मैं तुम लोगों को. आई हैव टोल्ड यू मेनी प्रैक्टिकल थिंग्स एंड ऑल दिस इज नॉट इन द बुक. I told you so that you can find the class interesting. If you read the book, CFA might or the Squeezer might, these things won't be there, right? Especially about PE and PB. Okay, now guys, we'll just do a small question, and after the question, we'll wind up with today's class. Guys, the stock price, we have to calculate the EV by EBITDA. Stock price is $40. Number of shares outstanding is 200,000. Market value of long-term debt is $600,000. Book value of long-term debt is $900,000. Book value of total debt is 2.1 million. Right, cash and cash equivalents are 2,50,000. And EBITDA is 1 million. Calculate EV by EBITDA. EBITDA is 1 million. Calculate EV by EBITDA. Chalo, calculate. How will you calculate this? Please tell me. First, calculate market value of equity.
Equity,
What is the market value? Equity.
200,000 into $40,
Excuse me. Yes, so market value of equity is 8 million.
8 million.
What is the market value of debt?
600,000.
First, write market value of equity is 200,000 into 40, which is 80 lakh or 8 million. Then we have to calculate the market value of debt. Now we have been given market value of long-term debt and we've been given book value of total debt and we've also been given book value of long-term debt, right? So we do not know the market value of short-term debt, right? Guys, my book value of total debt is 2.1 million,
2.1.
right? My book value of total debt is 2.1 million, right? Out of this 2.1 million, book value of long-term debt is 900,000. So what should be the book value of short-term debt, guys? Guys, what should be the book value
12
of short
lakhs
2.1 minus
minus
900,000, which is 12 lakhs, right? 12 lakhs, right? So, guys, we know the market value of long-term debt. We do not know the market value of short-term debt. So, since we do not know the market value of short-term debt, we will use the book value of short-term debt instead, right? That's what I told you. We do not know the market value of long-term debt, so we'll use the book. We do not know the market value of short-term debt, so we'll use the book value of short-term debt, right? So market value of total debt is market value of long-term debt plus book value of short-term debt. Why are we using book value of short-term debt? Because we do not know the market value of short-term debt. Now, what's the market value of long-term debt? Please tell me. कितना था?
600.
600,000.
And what was the book value of short-term debt? 12 lakhs.
12 lakhs.
So market
18
value
lakhs.
of debt is 18 lakhs or 1.8 million. Okay, now you calculate your enterprise value. It's your enterprise value is market value of equity, which is 8 million plus market value of debt, which is 1.8 million. and minus cash and cash equivalents. Cash and cash equivalents was 250,000. So your enterprise value is how much? 398, 95 lakh 50,000. Right? This is your enterprise value. And your EBITDA was how much? 1 million. Right? EBITDA was 1 million. So what is your EV by EBITDA?
95.5.
9.55. Right? 9.55. Now please
Yes.
interpret this number. Please interpret 9.55 for me. What do you mean by an EV by EBITDA of 9.55?
The acquirer is willing to pay 9.5 for
Yes.
each
Per dollar
dollar,
of EBITDA.
dollar of
Right?
EBITDA.
Acquirer would pay $9.55 per dollar of EBITDA. Right? So this is your idea. And one explanation that has been given in Squeezer is that if the average EV EBITDA of industry is greater than 9.55, if average EV EBITDA of the industry in which this company operates is greater than 9.55, then this stock is undervalued. Right? If average EV EBITDA of the industry in which this firm operates is greater than 9.55, then this particular stock is undervalued. And if EV by EBITDA, average EV by EBITDA of the industry is less than 9.55, then this particular stock is overvalued. Right, guys? Are we good? All good? Have you understood everything? Any doubts?